Good afternoon. I'm going to just stand so I can see this corner of the room right now. Quick survey because it will help us in guiding our discussion for your benefit. How many investors do we have in the room? Okay, decent number of hands. How about founders or entrepreneurs? Okay, that's what we expected, a little heavier that way. How many of the founders have raised a seed round? Okay, how many have raised a Series A already? Anybody? Probably not. You're probably, okay, one or two. All right, how many are looking, is like, so the Series A is on the radar? Seems like a good number. Okay, well that gives us better context. One statistic I wanted to share with you that is very pertinent to this conversation is that according to Carta, only about 13 to 15% of companies that raise seed rounds go on to successfully raise a Series A round. That percentage used to be around 20 to 30% before 2020 and is now in the low to mid-teens. So this is, Series A and Series A readiness is a very important topic, to see your company grow. And we will be happy to share some of the inside tips on, how to make your business shine during the diligence process and how to even get to the diligence process. My name is Ashley Keating. I'm the moderator for today, and I will briefly introduce our panelists as well. But just so you have some context, my background is in finance and transactions, and I've done a good amount of strategic board work as well, for, in one case, a public company for 5 years. But I was asked to moderate because for 9 years I was at a seed stage venture firm in Ohio, and just recently transitioned out of that role to build my own consulting business working with emerging fund managers and potentially some high growth companies. And my background originally was at PwC in New York and London, working in their transaction services group. So I'm excited to be here today with 5 of our panelists. Yes, we have a stacked panel. Let's see, we'll go down the line. So Brandon, he is a general partner at Sunset Ventures, which is a seed stage venture fund. Check size is up to about 100K. So he is not usually leading, but joining around. Their firm is based in LA and San Francisco and focuses on investing in companies that redefine how consumers live, work, and play. Before co-founding Sunset Ventures, Brandon was a principal at Samsung Next, where he led investments in emerging technologies such as Web3, gaming, and fintech. His portfolio includes notable companies like Wonder Dynamics, which was acquired by Autodesk, Ready Player Me, and The Sandbox, which recently became a unicorn. Brandon's journey began as a bank teller, progressing through roles at Morgan Stanley's top-ranked internet equity research team and as head of research for Samsung's chief innovation officer. He was recently recognized as a rising star of venture capital by Business Insider in 2023, and he holds an MBA and MPA from Wharton and then Harvard Kennedy School, respectively. And also one cool thing about Brandon is that he is the founder of Emerging LA, a community that brings together founders, investors, and operators in Southern California's tech ecosystem. And it's pretty clear his diversity in tech is evident, with his co-founding of the Diverse Founders Initiative as well during his time at Samsung Next. All right. Secret about Brandon is he also had a minor in music. Mark Lee is an investor at Mucker Capital, based in Southern California. So he drove in from LA this morning. Mucker provides pre-seed through Series A capital for startups outside of Silicon Valley. So your check size is what, 500 to $1 million usually?
On average, but we also invest in Series A as a firm. So yeah, it goes up to like 5 million.
Yes, and Mark specializes in the seed stage. Some of his notable companies include Audit Board, Service Titan, which recently had an IPO, and Honey, which sold to PayPal. congrats. Before joining Mucker, Mark was he had an impressive career as a product management leader at major tech companies we've all heard of, eBay, PayPal, and Visa. He also had his own firsthand entrepreneurial experience as the founder and CEO of Enroll Hero, a Techstars-funded startup in the health insurance space. At Mucker, he focuses on seed and early stage, and it's industry agnostic, but he has interest in consumer, SaaS, and healthcare sectors. His unique background with product leadership, and then also, of course, now investing, is a great addition to the panel. So thanks for being here, Mark. Howard is our next contestant. He's a partner at Morpheus Ventures, which is also in LA. He has over a decade of venture capital experience with expertise in robotics, healthcare, insurtech, fintech, prop tech, and deep tech. Lots of techs. He is predominantly a Series A investor. So average check size, the sweet spot from what I recall is 3 to 7 million. Is that correct?
Somewhere there.
Or 3 to 5, 3 to 7. He currently serves on the boards of several companies, Ingenious.Build, Rise, and Tagnos, and as a board observer for Morpheus Space, Rugged Robotics, and Rapid Deploy. And he has a background in electrical engineering and an MBA from UCLA. We will go down to Danny. Danny is a partner in Mac Venture Capital, also an LA-based firm. They like to write $1 million seed stage checks. Is that correct?
So one is the minimum. We go up to 3. The average is about 2 to 2.5.
Okay, so I'm careful with the check sizes. Got you. Before joining Mac, he was a chief of staff at Atom Factory, an LA-based talent management firm and angel fund. He focuses on the intersection of media and technology. His investment interests span a wide range of sectors, so API, developer tools, e-commerce, fintech, and emerging technologies. And companies in his portfolio include last mile delivery provider Fin, healthcare platform Mommy, financial product innovation company Exponential Markets, and software platform Bankloop. And Danny's educational background is in business. And then Hung Soo Choi is our last panelist. He's a partner at Knabe Martens, one of the largest IP firms in the country. He has over 24 years of experience in US IP law in various tech sectors like electrical engineering, computer science, artificial intelligence, semiconductors, and medical devices. He was named among best lawyers in 2022 through 2025 by Best Lawyers of America. He counsels on IP strategy and strategic patent procurement and management, including extensive experience on US PTO examiner interviews. So he provides a swath of advice really around IP due diligence, strengthening your patent portfolio, and being very strategic in that way. So while not an investor, a great angle into due diligence. I'll maybe kick it off actually with one question to go down the line. And Hung Soo, it's perfect because I wanted this one to end with you. You must have known sitting on the far end from me. I want to go down the line. What's the most overlooked part of diligence in your experience? So maybe common things that a founder is surprised by, or that maybe you think other investors overlook. Brandon. Or if somebody else wants to jump in.
I don't know if it's most overlooked. I'm surprised sometimes I hear people don't do it. It's important to us, which is talking to either customers or whoever the ICP is firsthand on our end, so we could, try to understand who they're selling into, who they're building for, confirm that the problem actually even exists, or it's a viable solution. So.
I mean, I think there are a lot, but I mean, when I focus on kind of helping founders get through Series A and kind of raising there, it's like having like some of the financial numbers and getting all of that like in order, not just revenue, not just like number of customers, right? Like kind of top end numbers, but like really being able to cut down by channel and really be able to look at like individual kind of customer types, look at your retention, look at your churn, like all those numbers, having everything in place. A lot of times it's muddy, and so yeah, that's one of the things we try to help our founders focus on.
Thanks, Howard.
Actually, just to kind of take what Mark said a little bit, I think we're coming from a Series A perspective. So oftentimes there's early product market fit. So there's some revenue that goes into it. I think sometimes the way it gets overlooked because in the seeds, oftentimes it's just about betting on founders and management teams. We still do. I think that's still the biggest part of what we do at the Series A. But really understand the unit economics of the business, right? How does that scale, right? I think that's really critical. I think that's where I think some founders maybe were not has as much rigor kind of to it when they actually go out, and that's a pretty important part of what we do because we are basically kind of accelerate growth capital as they already have the playbook, but how are they going to execute on playbook, and does that playbook scale, right? So to Mark's point, it's really an extension of that. So I think that's sometimes overlooked.
That makes sense. Danny.
Yeah, so I look at this from the seed perspective mostly. We look to come in and lead there, and I think just to expand on that, we are interested in your financials, right? However, at seed, it's usually very early. These numbers are not necessarily super real. They're mostly projections. But we want to dig in and see how you are thinking about your business, how you're planning and strategizing. And the financials usually point to which levers of the business are necessary and need to be focused on the hardest for the company to actually scale. And then just to kind of put a bow on that, we're usually, really curious what your KPIs are for you to successfully raise an A and try and work on figuring those out with you so that investors like these have an easier job and we all can, graduate up to the next level.
Hung Soo is the IP lawyer in the room. I suspect your answer to this question is IP diligence is often overlooked. But could you then share maybe a few key issues in IP diligence that you think are overlooked? And in particular, if you want to delineate seed versus Series A, you can. I'll permit that.
Sure. There are three main areas of IP due diligence are ownership of IP and quality of IP and third-party IP risk. So the ownership is critically important as when you do correctly the ownership, you thoroughly review chain of title for IP asset and make sure that the company actually owns IP they claim to own. Because ownership issue can be really important as ownership defect can be a deal breaker if it cannot be fixed. Next, the quality of IP, we review the validity and scope of IP. So regarding the validity, we review that the patent is valid over conventional technology and other requirements. Particularly, software patents have a unique requirement where you cannot get a patent for an abstract idea, and you need to tie the software with practical application. And regarding the scope, we want to make sure that the patent has the right level of scope, because you don't want to overly broad patents, then they can be more easily invalidated by existing patent. And also you don't want to overly narrow patent, then they may not cover infringing products. So you also want to make sure that there's at least one pending application in the family, we call continuation, to go after competitors' design around, as you cannot change claim scope after a patent is granted. Lastly, regarding third-party IP risk, I want to point out that patent gives the right only to exclude others from using your invention. It doesn't give the patent owner the right to practice their own invention, because a third party can have a patent that potentially cover the company's product. So we do FTO landscape analysis to search relevant third-party patent and determine whether the company's key products infringe one or more of those patents.
Thanks. Sorry, we're doing the water shuffle. Great service. So I did want to start maybe at the end and work backwards at the end, meaning, you know, we peg this as seed and Series A. So I wanted to kick it to Howard to start us off on thinking about the Series A. Two kind of questions for you, and I'm just going to ask them at the same time. Take whichever one you want first. What does it take to get a Series A? So I know you talked about unit economics, but as one thing you look at, but what risks are you willing to underwrite versus not? And then the other thing is just because of the climate right now, the funding climate, we're seeing a lot of kind of safe over safes or seeds with seed extensions and bridges. How does that lend optically to a Series A investor? Is that, you know, does that taint the company? So I'd love to hear your thoughts on that specifically, and then maybe you could segue into what's it take.
Yeah, so I think the nice thing about, I think, seed financing is that I think you have a little bit more give. There's more flexibility provided for seed stage from a company's perspective. A lot of companies have, you know, seed 1, seed 2, seed 3 even, or you know, a number of convertible notes and safes. I think from a Series A perspective, the challenge would be more if the valuations, on price round valuations, and frankly, if you stack 6 convertible safes or convertible notes or safes, that really crams down what your ownership is going to be after your conversion. That's more of the problematic. It's not so much the number of safes or the amounts per se, it's the other parameters involved with it, right? So if it's, let's say your seed round, it's like a 50 million post, and you're trying to raise a Series A now, you better hope that your the numbers or justifications there in order for you to raise at that level. If it's not, it's going to be much more challenging, right? I think it's more that, and specifically if you had like multiple like kind of seeds 1, seed 2, seed 3s. I've seen guys who raise $1 million here, $1 million there, $1 million there. It's fine. So long as you got to a point where the Series A is dynamic in terms of what we're looking for, stage-wise, where you got to, a lot of the Series A we're looking at right now is somewhere between 1 to 5 million ARR on the enterprise software side. And then in deep tech is a little bit different. The parameters for deep tech is a little bit different if it's like nuclear versus robotics, for example. Robotics now, believe it or not, is closer to how you look at enterprise software in terms of traction and whatnot. So really, it does depend kind of on the spectrum basis. Remind me what the first question was again? Yeah,
actually, I just have one follow-on to that, though, is do you look at capital efficiency? So they have to get to 1 to 5 million of ARR on, you know, I've had some Series A investors say they usually like to see, you know, 3-4 million in capital raised to get there. And if they're, you know, if they've raised 10 and they're there, does that, I mean, again, that might play into the value, as long as their valuation expectation is realistic, you're fine, right? But I was just curious if that's something you look at.
I think this is very context dependent, right? Let's say you pivoted, right? Let's say you were a consumer oriented first, and then you became enterprise, right? Or your product really shifted, right? Now, maybe you already recapped once before, and then you already cleaned that up, right? So context is really important. That's why like everybody asks me, well, what's your threshold? I'm like, it's not so much a threshold issue per se, it's the context around it, right? A $2 million a year ARR business that did $1.5 million the year before and got to $2 million this year is actually way less attractive than a company who's $800,000 ARR and they got to it in the past 6 months from 0 to 800, right? The momentum matters, the context matters, the payback on your customer acquisition cost matters if it's 3 months versus 18 months. So I think people get too enamored with one specific metric that they have to hit. Look at it as building your business. Build your business as a whole, right? Do you have a good business? It's more than did I hit a threshold is kind of how I would suggest most people look at it.
I tell the founders a lot, storytelling, not making up a story fictionally, but just how you articulate why you are where you are and the journey, and then what's of interest going forward. It matters. So so Howard, I did want to have you finish, and then I was going to kick the same question to you for seed, Mark, is just what's it take to raise a Series A for you first, Howard, risks that you're kind of willing to underwrite versus, where you aren't willing to take the risk?
Look, every company is going to have how I look at it is what's the leap of faith that I have to take in each of these companies? Whether is it a market risk perspective? Is the market going to be there if it's greenfield, like it's a brand new type of technology? Or is it a competitive risk? They have to outrace somebody, right? Ideally, I only really want to underwrite to one of those, one leap of faith versus like 2 or 3 or 4 leap of faith. But the one thing that I won't underwrite to is a leap of faith on management team, right? I have to be there on management team and the founders, that these are the guys I want to back. Over the years, sometimes we get too enamored with product and we get too enamored with market, right? That we sometimes say they're good enough. That's probably never the right thing to say. But I will take a risk on the market, let's just say if the market is going to be there, right? If there isn't a market there already, if I believe in the thesis that this is where the world is going, I'm okay with that. But I don't want to take the risk is on management team and founders.
That's helpful. And for the seed stage, right, there's even less to show for often go to market because sometimes pre-revenue or just 1 or 2 customers. Mark, what are your thoughts on the risks you're willing to take versus not at seed? Because albeit it's all risky, right? Even Series A still can be.
Yeah, I mean, we think about it in terms of, we think about risk, but like the seed round is really more about like potential. It's more like how big, how amazing can this be? We try to think more on that side. So that round is really about like telling that, selling the vision story, getting us really excited about it. As you get into Series A, then we really start to think about the risks because like you're kind of growing up, right? You're like an adolescent when you get to Series A, and so we expect you to have done your homework. When you say we expect you to kind of project like we're going to hit these numbers and we're going to grow here to here, and if you're not doing that in a consistent way, probably not ready for a Series A. And so kind of how we think about it at seed stage, we'll take lots of risks. We'll put money into like pre-revenue and whatnot, but certainly not at the Series A. We expect kind of the financial rigor, or at least kind of the beginning of it. A lot of times like this is when like fractional CFOs start to come in and like help out the teams. They don't necessarily have to have a CFO at that Series A stage, but it becomes more important. And then if I can just like throw one more thing, it's that like at the Series A, I guess like all stages, but really the Series A, like, you get your one bullet, right? You shoot it. And so like one of the things that we do see is like people shooting that bullet like too early at the wrong time. Like,
Or the Series A?
Yeah.
Yeah.
And so you just have to like, once you fire that bullet, we're not gonna, we're on to the next thing. If it didn't work out, we're not coming back. Like there are no U-turns, right? So you just have to figure out what is the right point when you want to fire that bullet. And so that's, I think that's really important.
That's a very good point. So I know the topic here is diligence, and so one thing that we felt was important to highlight is even getting to the diligence stage is usually hard to do, to be honest, especially when you consider investors get hundreds, thousands of deals a year that they're vetting. you have to be able to break through. So maybe Danny or Brandon, either of you can take this. Just maybe touch on your process when you think of pre-diligence, like how do you get into the diligence stage? And then we'll dig in on a couple of things in the diligence stage as well that kind of elaborate on what's already been said.
Yeah, for sure. So on our end, our process is mostly conversational. There is a point where we kind of enter formal diligence, but generally speaking, I usually have a couple of conversations, get to know you, introductory calls with founders, really kind of get a lay of the land as well, do my own sort of side market research, et cetera, and then kind of clarify any of my kind of open-ended questions, right? Basically, you need to convince me at this point that there actually is a business, there is an opportunity, and you're special and have an opportunity to nail it. At that point, I kick it to our broader team, and then assumedly other people get interested in as well, and we kind of dig in more. That's where we start doing customer calls, reference checks, maybe bringing in an industry expert or one of our other portfolio founders to kind of give us an idea on your tech stack or just kind of better understand your market. And then that's kind of where we go from there.
How would you view that as at the Series A, to get to your level of diligence? Anything different you feel compared to seed, Howard?
There's definitely more, usually more information by that point, right? Or like the customer set, what's your ARR, how's the customer build, is there a churn? Like there's just more data. So typically there are diligence rooms that at the seed, sometimes there's, heck, we do some seeds here and there too. It's not our core, but oftentimes there's just not that much to be evaluated against besides having conversations with the founders and whatnot, having a gut feel and have a thesis. But at the A, there's a lot more to that. The financial model, there's more granularity to KPIs. And so there's also the team sometimes a little bit more built, a little bit. In the beginning, maybe there's one or two guys and that's it. At that point, by the Series A, usually there is a team. It may not be a huge team. It could be 5, 6, it could be 10, it could be 20. But there's more to diligence. So there is more rigor kind of involved in it from a data and content perspective versus just conversations with founders.
Brandon, what do you mentioned in our kind of prep, you talked about product market fit. How do you think about that as it relates to diligence from your end? Being in seed stage.
Yeah, I mean, at the seed stage, generally, almost by definition of the stage, they're probably not yet at product market fit. But I think it is either internally us getting a sense of what that would look like. Again, the more we can understand the market, the actual problem that they're solving, talking to folks, that are current users or would be. But also, really getting a sense of how the founder is thinking about the space, the KPIs that they're going to be tracking and building towards. We see a lot of deals, and it came up even earlier in terms of the names of these stages. To make it even more complicated, pre-seed sort of, developed over the last 10 years. Some will still say that that's a non-existent stage, but it tends to be. Then there's a post-seed or a seed plus or an extension or a bridge. Everything pre-A, especially as the bars continue to get higher. We actually come across a lot of those deals. Naturally, the supply of those deals is pretty high. So you'd be surprised. I mean, they're even at $1 million in revenue, perhaps. But again, back to the notion of growth, I think is probably one of the biggest indicators. The momentum itself, could be indicative, at least, of product market fit, in the sense that it is starting to take off. The demand is, so strong that the team is barely able to keep up. And so, in context, if loosely, if product market fit is kind of the goal, and let's say that that's when and how the A could become possible, then anything before that in the seed stage, we're trying to just even underwrite and think, can they graduate? What would it take to get there? And that's something that we track, in the near term. And so again, we're going to be looking very closely at those kind of metrics there and evaluating, against other opportunities that we're evaluating at the time. It's all relative as well, where we're going to spend time diligencing. So again, in a given quarter, right, or in a given week, we are seeing hundreds. We're meeting dozens and dozens. And, I really want to see something that just kind of stands out, really a unique, I think, insight or framing of the problem that they're solving compared to a lot of similar pitches I've probably seen in that space. And if I'm seeing some growth, if I'm seeing some excitement, often we'll back channel. It's a lot of, talking to other people in the industry who likely know or have crossed paths with the founders to get comfort there. So really, it's a culmination of all those things to underwrite whether I think the team and, where the product is at and heading can reach, this product market fit.
Yeah, that makes sense. And, just thinking of Hung Su's IP specialty, I did have a question for the four of you, so anybody feel free to, jump in here. But how and when do you use the third-party experts in your diligence processes so that, the founders in the room, because that is something that will come up, but albeit, especially seed funds, I know, which can be smaller, very finite resources, right, and are deployed very specifically and strategically, if at all. So would love to hear your perspective on, who you've used as far as cyber or IP. Certainly we did do IP, but any in particular you lean on or you see repeatedly? Or is it really deal,
For us, I think it's kind of deal by deal, but we also have Mucker's been around in Southern California, LA for long enough where we have a pretty strong sort of network of founders and mentors. And so if we really have a question, we can dig in with some other folks in the field, but it doesn't come up that often. We try to simplify businesses to where we can understand it as individuals. And if it's an area that we really need to pull in PhDs to figure it out, it's probably not for us because we're not deep tech investors. We try to invest in companies that solve problems for customers in a simple way.
Howard, is your team, I know you do more deep tech and your background's in electrical engineering, do you do a lot of the sort of the tech validation within your own team, or do you pull, founders in for that?
Yeah, well, I think depending if it's a sector we haven't done yet. So let's say before we looked at our first nuclear deal, we probably consulted a few experts in that respective field specifically, because there is, not nuclear as a whole, but we were looking at a radioisotope nuclear medicine company, right? So we did talk to a few guys who were experts, and we used service providers to help us line up some of those experts for us. But frankly, on the enterprise software side, it's very few. Usually it comes down, by the time, especially at the Series A, there's a business. It might be early, right? But there is a business and a playbook, right? And that's generally fairly understandable. We've seen enough of those. We've seen enough companies, go-to-market strategies. Sometimes the tech, is that one better than others? It's going to be hard to differentiate anyways. So you really kind of, the customers almost are the vetting to some degree on if this tech is better than other tech, because also best tech doesn't always win. In enterprise software, that happens all the time, right? It's really about also your ability to sell, right? In addition to the tech itself. So it ends up being like that a lot. And on the deep tech side, we do sometimes use a bit here and there, but not prolifically. It's more, if it's a new sector too, similar to Mark, that we haven't looked at before, maybe we'll have one or two kind of calls.
Hung Su, what should we be doing for IP due diligence? Think about what people typically do at seed versus Series A, and then I do realize we have about 5 minutes, so I'll wrap up with one or two quick questions to the crew.
So assuming IP is a significant asset of the company, I think the three main areas of IP due diligence are generally the same regardless of the funding stage. So I mentioned IP ownership, quality of IP, third-party IP risk. So we are asked to relatively spend less time in seed funding diligence and more time in Series A funding diligence. And our business model is to develop really strong IP portfolio for our clients so that they can go to successful exit. I would like to point out maybe different technology sectors. For software AI technology, we want to make sure companies' unique algorithm is adequately protected by utility patent or maintained as a trade secret depending on the reverse engineerability. And for medical device technology, when company collects personal data from users, we want to make sure that the patient data is protected as a trade secret, and also that the company complies with all the requirements under the data privacy law, such as California Consumer Privacy Act. And for biopharma, we critically review the patent term. Generally, the patent term is 20 years from filing day, but it can be extended beyond 20 years if there is a delay in examination by US Patent Office or regulatory delay such as FDA approval process. So obviously the biopharma company want to recoup the significant investment in their R&D, especially during the later part of the patent term.
Thanks. I think, I don't know if this is a quick question or not, so if it's long, just say pass. But the question I wanted to ask you is, how have you changed your diligence processes, if at all, with all of the technology that's at our fingertips? Any tools, anything change? Because it is something that I feel is an interesting conversation. It's like all these venture funds. It's like, how are we using it? Anything notable?
I don't. I went back to the team and we're talking about it. No, it's Excel. we're building our model. We have our own models that we run, and so we really focus on a lot of the numbers, and then we talk to the customers. So you can't really AI that. I guess you could record it and transcribe it, but we don't leverage the latest greatest. But maybe there are tools out there that can help us.
Perplexity.
But
I've heard a lot say perplexity.
The ones that have been out there, the VCs like Correlation, I think Chamath had his own fund, but I don't think they've done well. I think ultimately at this early stage investment is about people, and so like tech isn't as helpful.
Or it's priced above what we're willing to pay as well. Okay, anything else to add to that, or Hung-Soo, anything in your world as far as tech that's changed your legal work as far as IP? Nothing notable. That's okay. All right. I will ask, what is the most memorable thing a founder has done, for the positive or the negative, that you just distinctly remember during the diligence process that either, where it made them a definite yes or a definite no? What to do or what not to do?
Look, it's not so much like that A1, but there was one who was much more blatant about it. And for me, it's a bit of a faux pas, which is don't say you know when you don't know, right? Or you're just trying to BS through an answer, right? And I had a guy who had Fortune 20 background, running billion-dollar P&L, and just the ego was here, right? And he had to know everything, right? Or at least present as if he knew everything. He was on that spectrum. And a simple Google search that would have taken 15 seconds would have said that was not right, right? Like that, I think, is a critical lesson learned. It's like, if you don't know, say you don't know and you'll get back to me. It's fine. There's nothing wrong. I don't expect everybody to know everything, right? If you don't know, you don't know. Right? Now, oftentimes we want to back people who are just experts and just super knowledgeable. They're the best at that industry and understanding their vertical, their space. That's important. But if you don't know, don't BS, right? And I've seen that kind of all along the gradient, and that's usually one of my bigger faux pas.
Well, I mean, tangibly for the founders that are going to be raising that Series A, I mean, it's going to be different per company, but in general, you want your revenues to be doubling every year. You want to retain 90% of your customers, right? And you want your net revenue retention to be like over 100%, 110%, something like that. And so it's like, we see the mistake of companies raising too early. I mentioned earlier, like if you don't have those types of metrics, probably like try to go get them before you raise, because again, you're gonna fire that shot too early. So
Seed extension.
yeah, just keep working until you get that consistency so that you're ready.
Oftentimes, the founder's like, I'm out of money. I got to go raise the Series A, right? And I have what I have as far as metrics. It's like, I don't go to that Series A check writer. You can introduce yourself, but don't make the pitch, right?
Just to one lever. If you have C stage investors like these guys over here who are really knowledgeable, leverage them. Ask them to Mark's point, are we ready? Because I've seen way too many times in the past, I don't know, few months, few weeks, every week there's a company who's pitching me like, you shouldn't be raising $15 million. You're not ready to raise $15 million. The problem is you can't come back to the VCs like, oh, no, I'm going to raise 3 to 5 now. Well, what happened? That means you probably got rejected by God knows how many investors out there, so you had to scale it back because you're not ready for it. Lean on guys who've been in this industry, live it day to day. They can give you good advice on, hey, where do I need to be at so you don't shoot yourself in the foot, because first impressions matter and it's hard to walk back. Fundraising is all about momentum. Once you lose it, it's really hard to get back.
So that plays into also when you're evaluating, for those of you who are thinking about raising a seed round, who you have join you and link arms with you is important too, because it's never going to run and go just as it seems, right? So having good partners is important, and it's often a personality thing as well. Do your skill sets match, but do you culturally fit? And you want to find a good partner, and I think that's often what these investors are looking for, is someone who they can work with that's coachable, but also teaches them too, right? Because they know the space really well. As far as timeline, and we have like about a minute left, maybe 30 seconds. Just as far as timeline goes with a diligence process, how long should a founder expect for seed versus A being more metrics heavy? Assume it's like a company that has their stuff together.
Yeah, so it definitely varies depending on the company, the sector, the firm. I would say for us personally, end to end, from first conversation to everything wrapping up, about 6 weeks. We get to a verbal indication sooner rather than later in that, and then on the back end, things like legal take their own time. So a safe round is going to go a lot faster than an equity round. But yeah, I would say it takes as long as it takes for an investor to get comfortable with the opportunity. So yeah.
Communication is important. So I want to thank our 5 panelists for being here. I really appreciate you joining me up on the stage on this topic. I tried to address some of the thoughts from the audience. Key things to take away is preparation. Think about your story and context. And also, there's no replacement for a good management team. And really think about that silver bullet, right? Like what is your story, and make sure it's going to hold, because you often don't get a second look. So thank you.